Welcome to the Deep Dive. Today, we're really getting into something interesting. Monthly dividend REITs.
Yeah, these real estate investments, they seem to offer this potentially great mix, right? Steady monthly income, plus maybe some long-term growth, too.
Exactly. And what we found really compelling is just the rhythm, that monthly check.
It's more than just the total annual payout. Getting paid monthly? Well, it can make budgeting smoother, and if you're reinvesting, that compounding happens just a little bit faster. It adds up.
It really can. But we need to be clear. The goal here isn't just finding REITs that pay monthly.
Right. Frequency alone isn't the prize.
Our mission in this deep dive is to look past that frequency. We want to pinpoint the ones that are built to last. Sustainable models, good properties, strong management, and crucially, some actual potential for growth.
You're not just chasing yield. You want quality underneath that monthly payment. Makes sense.
Precisely. That income needs to be reliable because the foundation is solid. So with that in mind, we've kind of zeroed in on three specific REITs that, well, they keep popping up. Realty Income Corporation, that's ticker O.
Ah, the monthly dividend company itself.
That's the one. Then STAG Industrial, ticker STAG.
Focused on warehouses and logistics, right?
Yeah, exactly. And finally, EPR Properties, ticker EPR.
The experiential one, movie theaters, theme parks, a bit different.
Very different. So yeah, three distinct players in the monthly dividend space.
And that diversity is key, isn't it? Different sectors, different risks, different opportunities.
For sure. So our goal today is pretty straightforward. Give you, the listener, the core insights into these three. Help you figure out if they fit what you're looking for, especially if that reliable income and potential appreciation are high on your list.
Okay, let's unpack them. Where do we start? Realty Income.
Let's do it. Realty Income, like you said, the monthly dividend company. They've actually trademarked that phrase.
That says something about their focus, definitely. Their reputation for stability is, well, it's pretty solid.
It really is. And get this, they're a dividend aristocrat. That means they haven't just paid, but increased their dividend for over 25 years straight.
Wow. That's impressive consistency.
And they've been paying monthly for over 30 years. I mean, that kind of track record, it just speaks volumes, doesn't it?
It really does. Shows resilience, commitment to shareholders, long-term thinking.
So, quick snapshot.
Yeah.
Yield is currently around 5.8%. They own a massive portfolio, over 13,400 properties.
Huge.
All 50 U.S. states, plus they're expanding internationally now. And the tenants, Walgreens, FedEx, Dollar General, Walmart. Big stable names.
A lot of household names there. And a core part of their model is a triple net lease, right? Maybe explain that a bit.
Yeah, good point. So with a triple net lease, or NNN lease, the tenant is responsible for paying property taxes, insurance, and maintenance costs.
Basically, most of the variable property expenses.
Exactly, which is great for Realty Income because it makes their margins really predictable. They know pretty much what their expenses will be.
Shifts a lot of the operational risk onto the tenant. And you mentioned diversification. It's not just the number of tenants, is it?
Right. They started heavily in retail, and that's still big, but they focus on defensive stuff. Pharmacies, dollar stores, convenience stores, things people need regardless of the economy.
Less cyclical, maybe?
Kind of. But they've also moved into industrial properties, even some gaming properties. And importantly, no single tenant makes up more than, I think, 4% of their rent.
That's solid diversification. Protects them if one tenant or sector hits a rough patch.
Definitely acts as a buffer. So looking ahead, what's driving their growth?
Well, a few things. That international expansion is a big one. UK, Spain, Italy, new markets.
Right.
Plus, they recently acquired Spirit Realty Capital. That was a pretty significant deal, adding scale.
Yeah, they seem to be positioning themselves as a consolidator in the REIT space. Could mean more acquisitions down the road.
Seems likely. But what about the potential downsides? Risks?
Well, like pretty much all REITs, they're sensitive to interest rate hikes.
Right.
Higher rates mean higher borrowing costs.
Sure, that impacts profitability and maybe valuations.
And even though the retail is defensive, the whole e-commerce shift is still a background pressure on the retail sector generally.
Yeah.
Something to watch.
True. Even necessity retail isn't totally immune to changing shopping habits.
But I think the main takeaway with Realty Income is stability. It's a blue chip kind of option for an income portfolio. Consistent income is really the name of the game here, maybe more than super fast growth.
Solid foundation. Okay, that makes sense. Shall we move on to STAG Industrial?
Let's do it. STAG, ticker STAG. Their focus is different single-tenant industrial properties.
Warehouses, distribution centers, The backbone of logistics these days.
Exactly. They've been paying monthly since 2013. Yield is currently around 4.1%. Portfolio is pretty big, too. Over 570 buildings, 112 million square feet.
Wow.
Spread across more than 40 states. And an interesting angle is their focus on secondary markets.
Ah, okay. Not the huge primary coastal markets necessarily. Why is that beneficial?
Well, the thinking is, by targeting these often smaller, maybe less competitive markets, they can sometimes find better pricing, higher cap rates.
So potentially a better initial return on their investment.
Potentially, yeah. And maybe less competition when they're looking to buy properties, gives them a bit more leverage.
Interesting strategy. And how do they plug into the bigger economic picture?
E-commerce. Big time. The massive growth in online shopping means huge demand for logistics space, especially those last-mile distribution centers. STAG is right in the middle of that trend.
So that's a major tailwind for them.
Definitely. And there's this idea of tenant stickiness, too.
Stickiness, meaning tenants tend to stay put.
Yeah. Industrial tenants often invest a lot in customizing their space, specialized equipment, specific layouts. It costs them a lot to set up.
So moving is a major hassle and expense.
Exactly. Which means they're more likely to renew their leases. Leads to longer lease terms, lower turnover for STAG, more stable revenue.
Predictability again. That seems key for these income-focused REITs. What about STAG's growth drivers?
They're pretty active in acquiring new properties. Tenant base is also well diversified. No single tenant is more than, I think, 3% of revenue.
Similar diversification benefit as Realty Income, just in a different sector.
Right. And most of their leases have built-in rent increases each year. That provides steady organic growth.
Automatic bumps. Nice. Okay, risks for STAG.
Well, being concentrated in industrial is one. If that whole sector slows down, or if a major tenant in a specific niche runs into trouble, that could hurt.
Sector concentration risk. Makes sense.
And again, interest rates. Higher borrowing costs impact them, just like other REITs.
Standard REIT risk factor there. So summing up STAG for someone listening.
I'd say STAG is a way to get direct exposure to that whole industrial real estate boom, especially the e-commerce angle. You get the monthly income plus a dividend that's been growing. If you're bullish on online retail and logistics, it's definitely one to look at.
Okay, clear positioning. Now the third one, EPR Properties. This one feels different.
It really does. EPR, ticker EPR. They specialize in what they call experiential real estate.
So movie theaters, ski resorts, TopGolf locations, amusement parks, things people do.
Exactly. Stuff tied to leisure, experiences, consumer spending. And we should say up front, this focus makes EPR inherently more, let's say, volatile than O or STAG.
Higher potential reward, maybe, but definitely seems like higher risk too, tied closely to discretionary spending.
That's the trade-off. You really need to understand that going in. Their yield reflects that, though currently around 7.3%. Quite high.
That's a significant yield.
It is. They've also paid monthly since 2013, but, and this is important, they did have to suspend the dividend during the pandemic in 2020.
Ah, okay. That really underscores the sensitivity to major disruptions, doesn't it? Especially things that stop people gathering or spending on fun.
Absolutely. Portfolio's over 350 properties. Big tenants include AMC Theaters, TopGolf.
AMC is a big one. And, well, the movie theater industry has its own challenges.
It definitely does. But on the flip side, EPR operates in a bit of a niche. Less direct competition compared to, say, standard retail or industrial REITs. And there is strong underlying demand for experiences, especially from younger folks, millennials, Gen Z.
People valuing experiences over things, perhaps. And management is optimistic about dividend growth now that things are recovering.
They are. Key growth drivers are, well, the ongoing recovery in travel and entertainment post-COVID.
Yeah.
That directly helps their existing properties.
Makes sense.
They're also diversifying a bit, moving into education properties, private schools, charter schools, maybe trying to add a more stable income stream.
Interesting. Less cyclical than movie theaters or ski resorts.
Potentially.
Right.
And they're also looking at other experiential areas like maybe esports arenas or fitness centers, trying to broaden that experiential umbrella.
Diversifying within the niche. Smart. But the risks remain. Right. What are the main ones?
Tenant volatility is probably number one. AMC is a huge tenant, and that industry faces headwinds.
Right. Dependence on a major tenant in a challenged sector.
Also, just general economic sensitivity. If the economy tanks, people cut back on movies, vacations, that sort of thing first.
Discretionary spending gets hit hard in downturns.
And, that 2020 dividend cut might still linger in some investors' minds. Creates a bit more caution.
Understandable. So how do we frame EPR overall?
I'd say it's clearly the higher risk, higher reward option of the three.
Yeah.
The yield is attractive. You get exposure to that experience economy trend. But it's probably best suited for investors who are pretty bullish on leisure and entertainment continuing to rebound and grow, and who can stomach more volatility.
Definitely requires a higher risk tolerance. Okay, so we've looked at Realty Income for stability, STAG for industrial commerce, and EPR for high yield experiential. How do they fit together, maybe?
Yeah, it's interesting. You could almost think of these three together as like a mini self-made ETF of monthly payers, right?
A diversified monthly income portfolio.
Yeah. Kind of. You get that potentially dependable income stream, but you're spread across different sectors. Stable retail, growing industrial, the more cyclical experiential stuff, different growth drivers too.
Tapping into various economic themes, different risk levels, all while getting that monthly check. I see the appeal.
So how might different people use them? Let's think about, say, retirees.
Okay. Income is probably paramount for them. Stability, too.
Right. So maybe they lean heavily on Realty Income and STAG for that reliable base, rock-solid foundation. Then maybe a smaller slice of EPR for yield boost, if they're comfortable with the extra risk.
Balancing stability with a bit of a yield kicker makes sense for that profile. What about dividend growth investors?
For them, that monthly payout is actually a neat advantage for compounding. Reinvesting monthly instead of quarterly just speeds things up slightly over the long term.
Right. More frequent compounding cycles.
Yeah. And all three have shown commitment to raising dividends, though obviously EPR had that pause. But the reinvestment angle is key for growth folks.
And for someone just starting out, new investors.
These could be great foundational holdings, especially using DRP's dividend reinvestment plans.
Automatic reinvestment. Builds wealth slowly but surely.
Exactly. That regular monthly feedback, even small amounts, can be really encouraging. Maybe start with O and STAG and consider adding EPR on dips, but really understand the risks involved there.
Good advice. Build the base first.
But here's the absolute key point, I think, for everyone.
Okay.
Don't just look at the monthly payout or the yield percentage. You have to focus on the quality of the underlying business. Are the properties good? Is management capable and shareholder friendly? Is the dividend sustainable?
That's it. The yield is only as good as the company generating it. Sustainability is crucial.
Totally. High yield with a shaky foundation isn't an investment, it's a gamble.
Well said. So, quick recap.
Sure. Realty Income. Think stability, dividend aristocrat, diversified necessity retail, plus industrial gaming. A potential cornerstone.
Got it.
STAG Industrial. Focused bet on industrial logistics e-commerce growth. Secondary market strategy. Good for that specific sector exposure.
Right.
EPR Properties. Unique experiential focus, high yield potential, but higher risk, more volatile. For those bullish on leisure spending and okay with bumps.
Clear distinctions.
And that monthly dividend aspect across all three offers that smoother cash flow, faster compounding potential if reinvesting. It's just a different rhythm for your portfolio.
A nice potential benefit on top of the core investment case for each.
Exactly. So the final thought for you, the listener, is really to consider how this idea of reliable monthly income, when it's backed by quality assets and good management, might fit into your own financial picture, your goals, your comfort level with risk.
It's about finding the right fit for your individual situation.
Absolutely. And always do your own homework, your own deep dive before making any decisions.
Definitely. Thanks for walking through these with me.
Yeah, this was a good one. Thanks, everyone, for joining our deep dive.